Hey everybody, it's Eric. In this video, I'm going to go into complete detail about a broken wing butterfly strategy for SPX. It's great for creating income in an account, maybe in retirement. It's also great to grow an account. It's very easy to put on. You're going to put it on once a week. It's going to end and you're going to rinse and repeat each week. Actually, this video was actually posted a couple months ago over on my Patreon page. Patreon is where I host all of my premium videos, my top strategies. This is one of those top strategies. I trade this with my members every week. So if you're looking to get first access to my best strategies, come check me out over on Patreon. I'm going to put a link in the description. There's also an option to take trade alerts. So if you want to trade this strategy and the other ones with me, you can do that over on Patreon with a couple hundred other members. And I'm going to put a link in the description with all those details. So be sure to check that out. So one of the things I love about this broken wing butterfly trade is the idea that we really are looking to just put it on Monday and the trade expires on Friday. There's 4 days to expiration, but you gotta make sure that these certain market conditions are met. It's a simple moving average condition. I'm gonna go into all the details and we're starting right now. Hey everybody, it's Eric. In this video, we're going to walk through the SPX 4 days to expiration broken wing butterfly trade that's going to be taken on Mondays. I put a couple little codes in here. 4DTE is the days to expiration and BWB is broken wing butterfly. So this is a systematic broken wing butterfly strategy, meaning we're going to try to take this every week at the same time if the certain market conditions are present. And this is a weekly income strategy. So as you guys know, we got to walk through the disclaimer. This is not a solicitation to buy or sell any security or option contract. This is definitely not advice. These are empirical, historical results based on backtesting of SPX using end of day options pricing. That's very important to remember. This is end of day options pricing. That's going to result in when we take these trades. The results and the strategy here are provided for informational purposes as a convenience to the viewers, that is you. This research is not a substitute for obtaining professional advice from a qualified person or firm. As you guys know, I'm an independent trader sharing the strategies that I personally trade and that I am not a financial advisor. So let's walk through the overview. This is going to be the fastest strategy video. I tried to make this as efficient as possible. So let's kind of talk through the strategy and then we're going to get into the platform and set the trade up so you'll know, and then we'll look at the results. So this strategy places trades towards the end of the day on Monday. This is a Monday only trade. And the reason why we're doing it end of day is because we're using end of day option pricing for the back testing. So this is an end of day strategy and the expiration is going to be Friday of that same week. That's why this is a 4 days to expiration. So on Monday, you'll open the trade if the market conditions exist, which we'll talk about in a second, and it's 4 days to expiration, which expires that same Friday. If for some reason the market isn't open on Monday for a holiday or something, then you simply just won't take this trade. And I did not test it to open it on Tuesday, so we're going to just avoid those. And same thing, if the market is closed on Friday, we're not going to open this trade. So there are some weeks of the year where this trade will not be valid because a lot of times holidays are fall on Monday or Friday with the stock market, right? So this strategy uses a moving average condition or filter before placing the trade. And the filter is the 3 EMA, the exponential moving average, must be above the 8 EMA when taking the trade. And this is important because what that tells us, when the 3 EMA is above the 8 EMA, we know that the short-term price action is more bullish than the longer-term price action. And we're doing very short time frames here, 3 and 8, and that's because this is a very short-term trade. So if this bullish condition doesn't exist on that day, then we'll simply skip the trade. The strategy, we're going to be holding this to expiration. There's no stops, no profit targets. This is a very hands-off trade. You're going to look on Monday afternoon if you should take the trade. And then if the condition's there, then you take the trade and you put it on and then you just let it go, right? So that's the strategy. And also, just to kind of reiterate, this is really only for SPX because SPX is cash settled. There's no assignment risk. I know some people try to convert things to SPY. I do not recommend this because the strategy is to hold it to expiration and you don't want your options to go in the money or expire in the money with SPY, because then you could get assigned, and with SPX it's just simply cash settled. All right, let's talk through the trade setup, where we're going to place the options on the chain here. So first of all, broken wing butterflies can be traded with calls or puts. They can be set up in the same sort of manner so that the risk reward is the same. And I'm going to kind of focus on the put fly today, but I wanted to just kind of let you know that you could trade this with a call fly. And there's a lot of times that I do, and we'll talk about that reasoning later. But in general, for the broken wing put fly, for this strategy, put flies, you receive a credit. And the short strikes of the trade, we're going to put at delta 55. And then once you find where delta 55 is, you're going to sell 2 of those puts, and then you're going to buy a put that's 2 strikes lower and buy a put that's 1 strike higher. That's what broken wing means. With the butterfly, the wings are equidistant, and with the broken wing, one wing is longer than the other. So that's where that term comes from. For the call fly, it's the opposite. You're actually going to pay a debit for the spread, and you're going to put the short strikes at delta 45. And we'll see on the option chain in a minute that a delta 55 put and a delta 45 call are just on the opposite side of the option chain. So it's pretty much the same positioning. You're just on one side of the option chain or not. And then once you find your short strike at delta 45, you're going to sell 2 of those. And then you're going to buy 1 call that's 2 strikes lower and 1 call that's 2 strikes higher, just like you would the put fly. So this is the general setup. The important part of this slide to take away is the delta 55 for the put fly and the delta 45 for the call fly. And let's go ahead and get into the trading platform, and we can see what this looks like. All right, so let's start with the chart of SPX, and I have 2 moving averages on here. The yellow moving average is the 3 EMA, and the blue moving average is the 8 EMA. And if I zoom out just a little bit, we're going to see that in general, when price is moving higher, the 3 EMA is going to cross above or be above the 8 EMA, indicating that the short-term averages are higher than the longer-term average, and you get this kind of uptrend, and the position of the averages are where the shorter one's above the longer one. As the market sort of rolls over or pulls back, the opposite happens. The shorter term average will cross below the longer term one, and then you're in a sort of a short term pullback mode. So what we're pretty much doing is using this moving average combination to filter out trades that we don't want to take. This drastically improved the performance of the strategy, because think about it, had you opened let's just say in this particular candle, you opened a broken wing put fly, and a few days later it's much lower, well, that trade would be a loser. Now eventually one might win, but what we're trying to do is only be in the market when the probabilities are in our favor, and that may not be every week. We may want to avoid bullish trades, and we're setting this up in a bullish manner, and you'll see this in a second. So that's the first condition. Before you even look at the option chain, you want to see what is the market doing. Now, since we're taking trades end of day, what we're going to do is towards the end of the day, we're going to look at these averages. Like right now, I'm doing this video, and it's maybe during the lunch hour. If the market, let me get this out of the way. There we go. That's better. If the market closes right here, then today the 3 EMA would close above the 8, and I would look to put this trade on. But if for some reason the market rolled over and sold off towards the end of the day and the average broke below, I'm going to skip that trade. So even though we're using end of day options pricing, the way I look at this is you have to make a decision towards the end of the day. Are you going to take this trade or not? If it's super close, for example, like let's look at this day. I don't know if this was a Monday, but let's just say this was, and you have a big sell-off, and technically this is, the 3 EMA is above the 8, you may want to consider skipping it. But in the backtest example, it would actually take this trade. So you're not waiting necessarily for the moving average to close, not waiting for the market to close. You want to enter at the end of the day and then hold that trade for 4 days. Because if you wait till the next day, anything can happen. The market can gap up, it can gap down, and it basically resets that position. So step 1, is the 3 EMA above the 8 EMA? And as of right now it is, so we would be looking to take this trade. So then we would hop over to the option chain, and we find the expiration that has 4 days to expiration. So since it's Monday, you're going to find one that's 4 days. This should be Friday. So what I'm going to do is let's go ahead and just set up the put fly. I'm in Tastyworks. They have this pretty cool button that kind of throws us on here. You can do I'm going to do a long put butterfly. and you can see that it's just going to put it kind of right at the money. So with the puts, remember, we want to find the delta 55 and put the short strikes there. So right now we have a choice between a delta 52 and a delta 56. So we're going to want to move the strikes here into the right position. So I'm going to go ahead and move it to the delta 56, and now we have a standard butterfly. If we look at this on the risk profile, this is what an equidistant wing butterfly looks like. And we know that we are going to break the wing here in a second. So back in the option chain, we have our short strike in place, and now we're going to break the wing. We're going to take the lower strike and we're going to move it one more strike lower. So now there's 2 strikes between the lower strike and 1 strike between the upper strike. We go back to the curve, and now this is what the broken wing put fly looks like. We look into, I'm going to lock this price in just so it doesn't move around as much. So right now we can get a credit of about 205. So since it's a credit spread, if the market rallies out of here, this actually becomes our max gain. And it's similar to a put credit spread in that sense, where your credit is the max gain. And if it goes away from you, then your max loss is $295. And when you add those together, you get $5, right? So the max loss on this trade is $295. And this is very typical. The typical max loss on these trades is somewhere between $300 and $325, I tend to find. So this is pretty a normal setup. But what we have is this massive income boost area where we can, even though we're risking, let's call it $300, if the market lands in this zone over the next few days, you can double your risk. I'm not gonna say you can triple it. It would be really rare for you to nail the actual strike at expiration, but you have this income boost area and then you have no risk to the upside. So if the market just rallies out of here, and again, we're taking this trade when the market's in a bullish condition. So in a lot of cases, you're not gonna hit this income boost area. It's gonna rally out of here, and you're gonna end up with that credit. So this is the advantage of the put fly, is if the market does rally out of here, all the puts that you're in will expire worthless and there's no closing fees. If you do it with the call side, then all the calls and the market rallies, then all the calls would expire in the money and you can pay some exercise fees. So you can reduce the profit a little bit, but again, there's a pretty good reason why we may want to do a call fly. So let's go ahead and do that. I'm going to take this off just so we can see it. So now we're going to put on a long call butterfly, and it's going to be very similar, but this time, instead of it being a delta 55, it's going to be a delta 45, because remember, the put fly is going to, we had over here at delta, it was delta 56 when we did it. We're basically going to do the same strike, but on the call side, the delta is going to be less. So we're going to move the delta down to, in this case, 44, because that's the closest one to delta 45. And then we're going to break the wing. So it's pretty much the same position in the option chain. It would be the exact same strikes and the same buying and selling, where you're selling this 4205 on the calls, that's a delta 45, and on the puts, that's a delta 56. And then you're buying one call above and buying one call below. So it's the same position. So if we go back to the curve, it looks like the exact same trade, except this time you're paying $3, which is your max loss, because before it was, remember, $3, $295. So our max loss is the exact same, our max gain is the exact same, and we still have the income boost area, and our risk reward is the same. So why would we want to do a call fly instead of a put fly? And the answer for me is pretty simple. Let me show you another trade I'm kind of in. This is a little bit different. In this particular example, I already have a position on the put side. So to not mess that up, I'm going to go ahead and take the butterfly position on the call side. That way my positions don't kind of overlap each other. Because if you were to sell a put and then you come in with another position and you're buying the same put, it would close this put out and you'd end up with a different position. So for me, these are two different positions that could have been started at different points in time. This is a put credit spread and this is a long call butterfly. So that's why we need to be prepared to trade both, because if we have a put credit spread position on, we don't want to mess it up by layering in a put butterfly on top of that. So that's kind of the reasoning. So we just need to be prepared for both. But again, it's the same risk reward. In this case, we're risking $3 to make 2 with an income boost of $400, $500, $600 here in the middle. So that is basically the trade setup, and I'll go through it real quick again. The 3 EMA must be above the 8 EMA. If so, we would look to put on let me go back to the 4-day expiration. We look to put on a long call butterfly where the short strike was at delta 45, or we would put on a long put butterfly with the short strike at delta 55. So that's the general strategy. All right, so now let's get into the results. All right, so I'm in eDelta Pro and I have the put fly set up already. We're just going to focus on the puts for now, but let's just kind of walk through it. We're looking at a 5-year study. We're looking at SPX where we are selling 2. There's a ratio there. I don't know if you can see it, but we're selling 2 of the delta 55 puts, and then we would buy 1 that's 10 points lower. In this case, that's 2 strikes lower. In the software, we're doing points though. So we're 10 points lower, and we're buying a put that's 10 points higher. This is the broken wing butterfly. We're doing 4 days to expiration. We're only trading these on Monday, and we want the 3-day exponential moving average to be above the 8-day exponential moving average. Now I've got SPY in here because there's some issues with SPX in the software, so I'm backtesting this off the moving average of SPY. Those are pretty much in line with each other, so I'm just kind of throwing that in there. That's why you see SPY. You should not trade this with SPY, but for the sake of the backtest, we're basing the moving averages off SPY, and that's really because there's an issue with SPX moving averages here. So not to get too deep in the weeds on that, but this is the basic setup. So again, if the 3-day EMA is above the 8 EMA, we would look to put on this butterfly with 4 days to expiration. Again, we're just looking at Monday. So let's go ahead and look at the results the past 5 years. You can see there was a 66% win rate. So the average winning trade was $215, and the average loss was $297. This is pretty in line with what we just saw. But here's the important thing for me, and this is where the expectancy comes in. If you're risking, I'm not going to call it $300. If you're risking $300 per trade, which is pretty standard for this trade, and your average win over, combining all the wins and losses is $42, that means your average win per week is 14%, give or take. Doesn't mean you're going to trade it every week, because again, you're only taking the trade when the moving averages are in line. But you can see that, there are some losing streaks here, but over time, it's like the market pulls back, it goes higher, it pulls back, it goes higher, and ultimately it has a nice uptrending status, although it's been pretty choppy over the last year since COVID. But ultimately, if you're risking 300 and averaging 42, I think this is a very valid strategy. It tripled your money over the last 5 years. And again, we're doing the 4 days to expiration. So that is the strategy. That is the results. And if you have any questions, let me know in the comments below. We'll see you at the next video.